Welcome to the True Wealth Podcast, where we specialize in helping aspiring homeowners break into the real estate market and help investors create and build wealth through real estate. We will be sharing some of our best advice around real estate so you can purchase your first home or reduce taxes and achieve financial freedom. Your host, Seun Adeyemi, is a certified financial planner, mortgage professional. Financial freedom is possible when you have the right mindset, coaching, advice, and community. So, let's get real.
Welcome to the True Wealth Podcast. I'm your host, Seun Adeyemi. Today, we're going to be continuing our conversation on investing in U.S. real estate. As some of you who've been following this podcast lately, I've been talking a lot about investing in the U.S. real estate market, mainly because the Canadian market is overpriced and the laws are not that friendly to landlords. And so a lot of landlords are losing money in the Canadian real estate markets because they're not able to collect rent from their tenants. So you have tenants sitting in homes for a year, 2 years, just for landlords to be able to kick them out. And even when you look at the numbers, the cap rates, the cash on cash rates, it's not conducive for an investor, at least not until something really drastic happens in the Canadian market. And I don't see that happening because I think the Canadian real estate market is a big part of the Canadian GDP. And so there's incentives from the top to keep the market inflated. Now, there's a lot of economic factors that can bring that down in the long term. But most investors who are currently invested in the Canadian market, not everybody's hoping that happens because people are going to lose money. So there are a lot of forces at play that I don't see the Canadian market readjusting to what will be conducive for an investor. And so if we don't see that happening, then that's why we're looking at the U.S. market. On the call today with me is Andrew Kim from Share. Share is an investing platform that helps Canadians explore the U.S. real estate market. They will work with you end to end, basically, to figure out what markets you want to go into, what markets are profitable, work with you running the numbers, what's profitable, and the different strategies. We're going to talk more a little bit about that. But before we get into the detail of that, let's welcome Andrew onto the show today. Andrew, how are you doing?
I'm great. Thanks for having me.
So, Andrew, tell me a little bit about yourself in terms of, before we get into Share, just your background to help us understand.
Sure. Yeah. Professionally, I'm a technology entrepreneur. Been building technology both for my own venture-backed companies and within high-growth divisions of large enterprises. My previous startup was built and sold out in California, started in LA, and then was acquired by a company in Silicon Valley. And this is my second venture-backed startup and also technology. And personally, I've always been interested in real estate and have been passively investing in real estate since 2010. First in Ontario, Canada, then in the U.S. I was introduced to the U.S. real estate market in 2011, and then was sold and liquidated all my investment properties in Canada, and just I'm solely in the U.S. now. Fast forward to today, and my two passions of technology and real estate are intersecting to focus on Share.
So tell us about Share then.
Yeah, so Share, we're an end-to-end investment service. We are digital asset managers. It's like investing in a REIT. So you get the institutional asset management, but it's direct ownership. So in a REIT structure, the asset managers typically keep a big chunk of the upside, if not all of it. In our case, we're saying you keep all of the upside, but we're going to give you the same sort of diligence, the same sort of rigor that an institution gives you, but the asset's yours and the upside is yours. And so we focus on the single family rental market. So we work with investors, identify the right type of home and the right type of region and financing strategy, and then help them get into that owning that home and managing and growing their portfolio over the next 5, 10, 15 years.
So through Share, investors are owning the properties directly. It's not owned in like a pool with other investors or anything like that. It's direct ownership, right?
That is correct. Direct ownership.
So what made you look at the U.S. real estate market? I mean, I have my own reasons, but why the U.S. real estate market?
Yeah. So, before, before knowing sort of the institutional footprint in the real estate market, it was just sheerly off of the economics that drove me to the US. So, like I mentioned, I started in about 2010 in Ontario, where you could get a home in the like well outside of the Greater Toronto area. We're talking, almost 100 kilometers outside of the core,
Mm-hmm.
where we could get a house for like $350,000, and this was like a foreclosed, beat up house in 2010. And at that time, I had been introduced to U.S. single family rental market, and the specific market was St. Petersburg, Florida, just in the Tampa Bay region. And I could get a house around $100,000 that would cash flow, have like 9 to 10% cap rates, and the cap rate included property management fees. And my homes in Ontario were low single digits and did not include property management. So that for my like as a starting point was like a jaw-dropping experience. So that's what got me into it. And then sort of fast forward and realize that the single family rental market in the US is heavily invested by large real estate institutions. And that should provide a strong signal that, this is an investable class. And one thing I think a lot of Canadians don't realize is that if they've got some sort of a pension, that they are indirectly invested in a single family rental fund in the US, because some of the largest Canadian pension funds back a lot of these institutional funds that are
Mm-hmm.
investing in this asset class. So that is like sort of the actual seal and reassurance that I get in the single family rental market in the US.
So most Canadians don't even understand, like, why is the U.S. market so different? Similar, there's similarities, but why is it so different? Why are the price points so, like, you're talking? I mean, today's numbers, a decent house, townhouse, let's say, GTA, $600,000, $700,000. On the flip side, just drive maybe 4 or 5 hours. You're looking at the same property for $250,000. Like, why
Mm.
such drastic difference? Even if I'm to convert 250,000 US, that's like 320, 350 Canadian. Like, why
Yeah,
such drastic difference? Like, what do you think is underpinning those differences?
yeah, definitely the number of metros and the diversification of sort of the job and sort of population growth. So
Mm-hmm.
if you look at Canada, you've got like a few single digit major metros that a lot of the immigration and population migrate to: Toronto,
Mm-hmm.
Montreal, Vancouver. In the US, you've got a lot of different metros throughout the country. And then you dive into those metros, and the job market is very diverse. You've
Mm-hmm.
got, in any particular market, you've got logistics, technology, health, manufacturing. So you got diversification there, but the sheer population is unparalleled, right? Like you've got actual spread and immigration in the country. So you look at, Toronto as sort of the biggest market in Ontario, and then you look at Atlanta, and Atlanta's bigger than Toronto in terms of population, right?
Right.
And Atlanta's not even the biggest metro in the country. And then you look at the price points, and people migrate to Atlanta for a number of reasons. They got a lot of Fortune 500 companies, and now you look at the downtown core of Toronto versus Atlanta, and then you drive like, let's call it 20 miles or 35 kilometers outside the city, and you look at that price point difference. It's drastic, right? So
Mm-hmm.
Atlanta, the average price point of the home is around the national average. And then we go just outside those major metros and we're below the national average. Now, you
Mm-hmm.
look at Canada and you look at Toronto, and everything is above the national average. It's just exceptionally high.
Mm-hmm.
So the affordability is an important piece. And then sort of the rental demand, and, obviously being near a major metro is important. So you've got rental demand dynamic as well as affordability.
Now, when you think about population size, and I don't think that's something that we think through quite enough, in the sense that just looking at the big numbers, U.S. is 300 million, give or take. Canada is 30 million. Now, even though landmass, Canada is probably a little bigger than the U.S., but when you look at inhabited landmass, uh, U.S. is
It's
much.
sparse. Yeah, I mean, like
So
the
sparse.
population of California is larger than Canada, right? I think California is north of 40 almost. Canada's
Exactly.
around 30. Yeah, so it's nuts.
And so when you going back to the part of the dynamics that makes the Canadian market so different is that the populated areas are so much smaller because yes, Canada is much bigger, but there's the flatlands, there is the mountains, there's places that are uninhabited. So that's one aspect of it. The second aspect of it is typically when people are migrating to Canada, they're generally migrating to specific locations, GTA area, Vancouver area, Calgary area. And so the population, even though there's this huge population growth in Canada, if you look at last year, the year before, they're only migrating to select areas. And so that's driving up prices in those areas where there's other parts of Canada that people are not even really going into. That's one part of it. And the second part of it is when you look at the job growth and the industries that are moving to these places, the US market has such a bigger, diverse market that can handle growth. And so there's a lot more, even when the population growth in the US, they're more spread out, like you said, with this, a lot more metros. And so there is a basic economic principle of demand and supply that I'm seeing across the borders just south that influences the prices for this homes.
Yeah, and like that is exactly it. And like even from a sort of looking from a downside protection side, like that diversification of market is so critical, right? Like I
Hmm.
think in Canada, a lot of the investors from let's call it British Columbia and Ontario are saying, hey, well, we could just go to Alberta because, you know, Alberta's like Texas of Canada, but you could
Hmm.
just go to the Texas of Texas, right? And you get the diversification there. Like if you look at the various industries and the population, like the job distribution maps of the different industries in Texas versus Alberta, like Alberta, you're going to see a significant chunk of the job being in like oil, gas, energy. You
Hmm.
know, if are we confidently saying that over the next 20, 30, 40 years that that is going to be the energy source of this world?
Hmm.
And if so, what's going to happen to that industry? Like we don't want, like if you're investing, you want to make sure that the job market is rather diverse, so you
Hmm.
don't get like a Detroit scenario where the automotive industry collapses and everything you've got, like you've had a multifamily there and everything just collapses, right? So
Hmm.
you really want to kind of diversify on markets and job markets as well.
Which brings me to the point. When I started looking outside GTA, one of the provinces I looked at was Alberta because the prices were decent. You can still get into good homes. But what made me pull back a little more is when I look at how cyclical Alberta is, right? Because of its major dependence on oil. I remember 10, 15 years ago when droves of people were moving to Alberta because it was booming, the oil market, the oil prices were, it was a very strong industry. And so that drove population growth. Fast forward to about maybe the last 3 to 5 years, and that's reversed. And so now a lot of people have left Alberta because the diversification in the job market is so small. And so
Mhm.
yes, you can find the prices you want, but like you said, it's hard to be so dependent on one sector of the industry to drive the job growth in that area, which puts investors at risk for those cyclical changes in the job market.
Yeah, yeah, definitely. And like to kind of hammer home the resiliency and sort of the investment factor is that like with such a heavy institutional presence in the US single family rental market, the surrounding ecosystem had to develop, right? So
Mm.
we're looking at like real estate funds that have deployed hundreds of billions of dollars across select states. So they own over hundred thousands of homes. Now
Hmm.
you need operators to operate that. You know, the funds aren't building a vertically integrated business. They're not building their own property management company. There are third-party property management companies that only service institutions and can provide a higher level of service and quality. But
Right.
there are also mid and small boutique agencies that will do for individual retail investors. Now, you look in Canada and you look in the Ontario market, there are no such thing as like single family rental property management companies that service institutions because there's no institutional presence. You
That's
don't even
right.
get a you don't even get a legitimate property management company unless it's like a small boutique mom and pop where they've got
Hmm.
maybe a handful of clients that they're really sort of, you know, tailoring their service offering to. So usually typically landlords will have to kind of figure out who's a local contractor that I can actually lean on, or I've got to build my own Rolodex and be their self-manager from
Hmm.
afar and deploy a plumber or an electrician or a contractor, and that can become quite time consuming and a bit scary.
When I see the US market and the diversity, it's really encouraging, at least for an investor, that there is, like, when you have the big players moving into these industries and being able to support the growth there, that gives an investor confidence in terms of
Yes.
investing in those areas. But at the other end of it, sometimes you hear Canadians afraid of similar situation, that the meltdown in 2008, where the US real estate market collapsed. And at the back of many Canadians' mind is like, okay, if I go invest in the US, do I run the risk of having the same issue where the property prices collapse and my people lose money? What do you say for those who have those concerns still at the back of their minds?
Yeah, it's funny because like that collapse really brought the single family rental market to the limelight.
Mhm.
So although there was a like that was like a sort of a it was a byproduct of the subprime mortgages and all the overlending and
Right,
lack of diligence, right? But what like prior to the '08 mortgage crisis, institutions were not investing in single family rental markets. But what they realized and what they started to operate in is how resilient the single family rental market is. So when you look at the price points, so in a down market, rental demand skyrockets. So it allows them to raise rents on a better than normal cadence if they'd like, because there's no rent control.
right.
And these are long-term leases, so you can have tenants signed for 12 months, 24 months. And now at least you know what your revenue line is, and you can kind of streamline that and against your hard costs. And then in an up market, it gives you an opportunity to sell and get your multiples or refinance and get your cash out.
Hmm.
So that is what brought a lot of institutional limelight to the single family rental market. In terms of the price collapse, the single family rental market, we look at these as long-term investments, 10, 15 years.
Hmm.
And if you can ride out, and that's what makes these resilient as an investor. As a homeowner, that is a different story, right? That collapse was for the homeowner that was over leveraged, and then took the downside. But as an investor, if we looked at investing in like 2006 and you hold for 10 years in 2016, you would have 2x the value of your home, right?
Correct.
But so back to the resiliency of it, it's like you have that home, it's going to be cash flowing. Nothing's changing. The value might dip, but we see
Mhm.
that there's more price stability when you're in the sub national average range, because that is typically where you have a stronger rental demand of
Right.
that price point. So that price point is rather stable and resilient compared to sort of the higher price point homes of New York, LA, San
Hmm.
Francisco,
Hmm.
Toronto, where the high price points took a major hit and will continue to take major hits. But the other thing that also gives the investor ease is that as an investor in the US, there are investor friendly mortgages that underwrite the house and have very friendly terms like 30-year fixed. So now imagine you get a house, you have a 30-year fixed term, you know your hard costs, you have your hard revenue lines. You can ride out a storm because nothing is going to
Hmm.
be fluctuating and it's not variable. So a
Hmm.
lot of stability opportunity in and around the whole single family rental market.
I think one of the mindset shifts Canadians have to make is because we've become so accustomed to this massive increases in real estate prices from year to year, that when you're looking at the US market and you look at the growth rate, you're wondering, okay, I bought a house for $250,000. But in 2 years, it's only grown to like 400,000, which is still a good growth
This
in
is great.
years, right? But for
Yeah,
the Canadian psyche that has seen a property that they bought at 550 moved to 800,000, $900,000 in 2, 3 years, they're looking at those dynamics and saying, well, I can get better growth in Canada. But what we're forgetting is that the ability for you to service that mortgage on that property in the long term, right? If I'm
exactly.
buying if I'm buying a property for much cheaper in the U.S. market, and the rents are similar to what they would get on the Canadian space, regardless of what happens in the market, you're building cash flow because now you're starting with a smaller mortgage, which is being paid off on a 30-year fixed. If you have a good rate, if you have a pretty good rate, you don't have to worry about those 5-year fixed mortgage rates in Canada. You have to keep renewing every five
Right.
years, and now you're caught between, well, rates have gone up. Now I've got to renew my mortgage at a higher rate, which eats into my cash flow. You don't have those problems on the US side because you have this 30-year fixed mortgage. Imagine those who got into the market 3 years ago at 2.5, 30-year fixed. So you have this fixed cost in your carrying cost for that property and your rent, because there's less rent control on the US side. So your income is somewhat fixed or even going up. So even if markets fluctuate, you're getting that cash flow because one, your mortgage is being paid down, two, rent is increasing. So even if the market flows and dips and goes ups and down, there is consistent cash flow that you're building for 5, 10, 20 years down the road, which you can then decide either cash out, refi, double up and go back into the real estate market to buy more, which most Canadians are not used to seeing because they're thinking short term. I want to be able to refinance or cash out in 5 years or in 3 years. And that's not a realistic model or a
Yeah.
resilient model over long term.
Yeah, totally agree. And like the beauty of these mortgages too, like they underwrite the house, not the borrower, right? So they,
Hmm.
most times your track record as an investor will weigh more so than having a credit history. So being able to scale your portfolio is a lot easier because
Mm-hmm.
these mortgages, they look at the debt cover ratio. They want to make sure that the rent rates cover all your hard expenses, and they'll lend to you like a million times over in a year. So you can stack a portfolio pretty quickly as long as they're revenue positive.
Mm-hmm. Which is different on the Canadian side because I'm mortgage licensed as well. And typically when we are underwriting rental properties, uh, we're looking at a combination of the client's ability to service that property from their income and some of it from the from the income from the rental property. So there's a bit of a good mix with the credit worthiness of the buyer and the ability for that rental to provide some income to service that. On the US side is a bit different. They're not really looking at your personal credit. Yes, that may factor in depending
Right.
on some properties, but they're really looking at the ability for that property to provide the income, which is a big way to scale a property because in Canada, by the time I buy 2, 3 properties, I've maxed out my income. I've maxed out my ability to increase my rental portfolio. But in the US, it's a completely different ball game. If that property can serve, if the income from that property can service that mortgage, I can easily go back in over and over and over and over again, which is so different from the Canadian side. And
Yeah.
so Canadians really have to shift their mindset, especially if you're not getting the returns on the Canadian side. Why not just look at the US side? Lower price points, better stability, better ability to acquire mortgages can cover um, that can cover the property and produce income for you.
Yeah. I often say that the US single family rental market is the most Canadian like real estate investment.
Homeownership culture, do you see any differences in the Canadian understanding of that and the US understanding of that?
Yeah. So like I feel like it's shifted quite a bit. So in the US, I feel that more people are already kind of acceptant about like I'm not going to own a home, but and willing to kind of invest out of state. Um,
Mm-hmm.
and what to give you context on the mindset that we're mainly exposed to are those individuals coming from the major metros like New York, again, like sort of California, New York, are the big ones, major cities there, where the price points like Toronto are very high.
Mm-hmm.
Um, and they're realizing, hey, I could actually just, I want to get into the real estate market, but I can't afford to do it locally. So let me just invest out of state, continue to build equity, wealth, while I just continue to rent because this is where I want to live and this is near my job where I have to live, right? So
Mm-hmm.
I feel like that is becoming more common, but for an American, it's easier pill to swallow because for them, they're still investing domestically. Whereas a
Mm-hmm.
Canadian, like I don't think they're really thinking about that as much because if you're in Toronto or Vancouver, investing into another province is a difficult process. Like I said before, there aren't the operating partners that make it very easy for you
Mm-hmm.
to scale that portfolio. And it becomes quite a bit of a high touch, high effort process.
Right.
So which is, we're kind of saying, well, we can help you with that mentality. You can go to the U.S. and start getting into the real estate market,
Hmm.
and start building your portfolio there.
Yeah, I think when you look at the institutions that service the real estate market, it's so much bigger on the US side. So the idea of investing out of state is a lot easier because there are institutions that help you with renovation, with property management, bigger institutions than they are in Canada. It's a harder pill to swallow on the Canadian side because you want to go invest in Chatham, you want to go invest in some other city 2 hours away from you. There's the infrastructure to help you manage those properties are not there. Whereas in the US, you have lots of that and really good ones. And that's one of the values that
Yeah.
Share brings in is that institutional management of that property, which makes the idea in the US that even if I cannot afford a property in where I live, I'm just gonna buy something out of state and have somebody manage that. And so that culture is, and that mindset is different in the US. Whereas in Canada, if I can't afford where I live, I basically just stay a renter for the rest of my life. And that's part of the psyche that we're trying to
Yeah.
get Canadians to get out of that. Yes, it may not be possible in Canada because the infrastructure is not there, but it is very possible in the US. And that's where Share comes in to help homeowners or investors get into that market. Two things before we wrap up. Can you talk about what remote out of state places are you finding are very good investments for investors? And then secondly, how does Share help in that process? Break down what the process looks like.
Yeah, so I think you actually nailed it earlier, where if you see an institution in a specific region, that is probably a good strong signal. So we are investing or gearing or you know, guiding a lot of our investors to a lot of the same places.
Hmm.
The Sun Belt, typically down south, all the warmer states, and up the sort of southeast coast.
Hmm.
Right now, we're kind of tiptoeing around a certain few states, Florida, Nevada, Arizona, but all the other ones are kind of in play: Texas, Georgia, Carolinas, and some of the Midwest and central areas, Ohio, Tennessee, Alabama, Kansas, Missouri, those types of regions as well.
Hmm.
That's where we're kind of gearing. But where we really kind of take our cues are from client appetite. So we do have this hypothetical A, B, C type categorization.
Hmm.
And on the opposite sides, one is strong appreciation and the other one is sort of strong cash flow, because typically they're inversely correlated. And then the higher appreciating assets are typically higher in cost, whereas the higher cash flow are lower in cost. So depending on where they sit on that spectrum, we'll guide them to certain metros in those specific
Hmm.
states.
So to help me better understand it, when an investor wants to get into the investment market in the US side, you're looking at a combination of is the investor looking for a higher capital appreciation or are they looking for cash flow? Because then that kind
Yes.
of informs the state you go to, the suburbs you go to, because like you said, a higher cash flow uh, typically probably means lower cost and
Yes.
higher appreciation in the back end typically means it's a newer home, higher cost, so higher entry point. So that kind of guides
Exactly.
does it guide just the state or it guides even the zip codes within the states?
It's within the zip codes within the states. So we would like, for example, like a higher appreciating asset, we may prefer certain metros in certain states over all of the other ones.
Hmm.
And then for the higher cash yield ones, you can find those in every single state, but there are certain metros that we would sort of bias towards because
Hmm.
those are the ones where we think in maybe the next 10 years, these may jump another status to like higher appreciating home.
Right, right.
Yeah. And the price points fluctuate. So like the ABC, like an A in like Texas might be different than an A in Atlanta or Georgia.
Can you explain what the ABC is?
Sure. Yeah. So the A's are A being the higher appreciating assets, and then C's being the higher cash flow assets. And the price points are, from A's being in like the mid 300s and C's being in the mid 100s.
Hmm.
Again, A's being higher appreciating, lower cash flow, and then C's being our higher cash flow and low appreciation. So those C areas, again, you could find throughout any single state, but the areas we go after are regions that we believe could potentially jump into a B class in the next 10 years. And that's what kind of everyone's hoping for.
So what's the process like if for an investor that, okay, I'm ready to jump in, how does it work with Share?
Yeah, so you go to your site, your links will probably be associated to this podcast, create a free account. We're gonna have a series of phone calls where we're gonna share these details of these different types of houses, understand your financing strategy, and then we're gonna put some numbers in front of you based on A, B, and C type home with whatever financing strategy you guys are wanting to pursue. That way you get comfortable with the numbers, the returns, the cash requirements. And then after that, if you're comfortable and you say, hey, let's go, we ask for proof of funds, we'll set up your company, and then we'll start searching for a home, both on market and off market in those particular regions. And then when we find something, we'll do all our full diligence on it and then bring in the necessary teams to have a very clean and streamlined closing. And then once you take ownership, our team will renovate and lease and then take a long-term management role.
So for an investor, I don't really have to stress about, okay, if I buy a property that needs repairs, I need to find someone to help me fix it. I need to, like, in terms of timelines, closing, lawyers, drafting paperwork, and all the requirements to take the house from, I like this house, to now I own this house, to now this house is being rented out. Share basically takes the load off of that whole process.
Correct. We do end to end.
Well, when I first found out about you guys from a colleague, I'm like, this is exactly what I've been looking for. I really appreciate your time helping us break down some of this.
My pleasure.
Why the U.S. market is really, really a lot more lucrative than the Canadian market. I definitely want to have you back on the show because this is just the tip of the iceberg. There's so much more to talk about in terms of ownership structure, tax implications of owning U.S. real estate, and the very facets of being an investor and an informed investor. So we're probably going to have you back on the show, Andrew, or maybe somebody from your team to explain the different aspects.
For sure.
I really appreciate your time on this.
Oh, thanks for having me.
Thank you. You've been listening to the True Wealth Podcast. Catch you next time.
This is all the time we have for today. Thanks for listening to the True Wealth Podcast. Don't forget to rate, share, and subscribe to the True Wealth Podcast on your favorite podcast platform. Follow us on Instagram, Twitter, or Facebook at True Wealth Pod. We'd love to hear from you. Share your thoughts, ideas, and questions with us on our social media platforms or email us at podcast@truewealthadvisors.ca. And who knows, your question might be the subject of a future episode.